Hello and welcome, I'm Nick. Thanks for joining me today, and today I'm going to talk about DRIPs. Not leaking taps, but dividend reinvestment plans. And I'll be using my own portfolio to explain what I look for in a company and what I decide is, important for choosing whether to purchase this share for dividend reinvestment. Now there's quite a long list of things I look for in a company to decide whether or not I'm going to invest in them. Every criteria doesn't have to be filled, but the more I can get, the better. So here's my list, and hopefully I can explain which ones are which and why I determine them to be as important as they need to be. So then the list is earnings per share, dividend yield, dividend cover, the debt to equity ratio that the company has, the historic rising or consistent dividends, the payment dates, and what sector the company is in to ensure that the portfolio stays quite diversified. So let's go through these one by one and I'll explain what they are and why they are important for me. So we'll start at the top of the list with earnings per share. And this is worked out by dividing the company's net profit by the number of shares it has. What I look for is as high a number as possible, but would always need to be above 1. I would say if it's less than 1, then it's earning less than the shares that are out there, so it's looking like the company isn't really making any money. However, if it is less than 1, there are other reasons why I would accept the company, and this would potentially be more for the longer term rather than in terms of a short term holding. Dividend yield, this is the one that anyone who invests is going to know what it is. This is the one most people look at first when dividend investing. Obviously, the higher the yield, the better return you're going to get from your investment. The yield is worked out by taking the total of all the dividends paid in that year and dividing it by the share price. Again, the higher the yield, the better chance it has of being introduced to my portfolio. Dividend cover. This is something that you might not look at or even know what it is, but this is one of the most important factors that I consider when looking at a company. This is the ratio between the earnings per share and the dividend per share. Anything less than 1 implies that the company doesn't have the money to pay out the dividend. I mean, it still will pay out the dividend, but it shows that it's likely to be unsustainable, and therefore in the future it'll either reduce its dividend or it could be in more financial trouble. Then the higher number the better, but anything over 2 is good. Debt to equity, it pretty much does what it says on the tin. It's the percentage of the company's debt or liabilities compared to its equity and assets. Ideally you want as little percentage as possible, but with anything there is always going to be elements of debt involved. If I think about the mortgages I have on my rental properties, these are all around 75% loan to value, so that would be my debt equity rate. I would generally look at a company with less than 70% to know that there is equity there to pay down any of the loans that it has. Historically consistent dividends. Again, this is something I don't think people spend a lot of time looking at, and if you want a reliable dividend every year, then the more consistent a company is at maintaining or raising the dividend, the better. Another good indicator of this is the 10-year growth, showing that even if there are some years where the dividend is reduced for whatever reason over the long term, you're still going to be making a gain. The distribution or payment dates. This is one of the least important things, as the dividends are reinvested. It doesn't really matter when the dividend is received because it is automatically reinvested into the portfolio. It's not like I'm taking the money out when I get it. It's always good to know when the payment dates are and how many payments the company makes. Sometimes it's just an interim and a final, others might pay quarterly, some might only pay 1 yearly. It's always good to know. And finally, the sectors and ideally the diversification. I never want to put all my eggs in one basket, and this goes the same for investing. I personally don't want to have too many companies of the same sector in the portfolio. Now, it doesn't need to be like the very specific sector which the company works in, but a more umbrella term such as telecoms, mining, banking. It doesn't need to be as specific as gold or copper mining or mobile phones or broadband. Just a sort of umbrella term is good enough. Now, just one other thing to point out before we get into the portfolio, with this being a dividend reinvestment plan, all the dividends that are paid out are reinvested back into the portfolio, which grows the shareholdings. So the next time I get a dividend paid out, it's obviously going to be more, and then that gets to be reinvested, and then it'll grow the portfolio that way. And hopefully it can do it very passively. So now we've gone through what I look for in a company and why I would pick them for the portfolio. Let's get into it. This is a portfolio that I've put together purely for dividend reinvestment. However, you're going to see there are a couple of companies that are in there just for growth. These should have gone into a growth pie rather than a dividend reinvestment pie. But the aim with these are, when there's been enough growth on them, sell them, take the capital, and grow the dividend paying stocks more. So then, in we get. This is what the whole portfolio looks for right now, and you can see that been a bit of a sell-off yesterday. Just a bit unfortunate. The American joblessness claims came out. A lot of the earnings reports were good, but unfortunately there's been a bit of a panic in the market. So if I'd have done this video last week, it would have been much better than what it is right now. So into the account, we're still 3.13% up, and this was set up on the 1st of July. So it's not bad returns so far, and especially when no dividends have been paid out, it's always good to see a gain. Right, so now we're here. This is the dividend reinvestment pie. As you can see at the moment, I've got 13 companies in here, 2 of which don't actually have any holdings of it yet, but they're going to get added onto the next time I deposit some funds into the account, and everything else is going to be rebalanced. So I'll just pick a couple of these shares that I want to talk about and explain why I've put them in the account and why I'm holding what percentage of each company. Obviously, the ones that favour more or pay a better dividend, I'm going to hold a high percentage of, and these that are a bit more speculative, I'm going to keep as a lower holding just because there's a high risk on them, but I'll explain about those in a little bit. So the first one we're going to start with is Rio Tinto. As you can see here, it's that sell-off from yesterday that's really affected the share price. So we are down 1.51% today, but over the entire month so far, it's up 5.5%, so can't really complain too much. As I scroll through here, we can see the earnings per share rating and the dividend yield. So it's £5.97 per share. That's good earnings, and 6.25% yield. It's pretty good too. So with the holding at the moment, I do have 10.13%. And even when I rebalance the portfolio, adding in new shares, I am still hoping to keep this at 10%, just because it's a solid company and it pays out a good dividend all the time. Next, we've got AT&T. Mainly, I want to be able to own stocks not just in the UK, but also in the US as well. The different markets move in different ways sometimes, so it's always good to diversify the portfolio away from just the FTSE and just the UK. As we're scrolling down here again, we can see earnings per share is $2.23. Not as good as Rio Tinto, but it's still positive gain, and 6.9% yield. Again, fantastic yield paying company. It's always good to have in a portfolio. Now, I know the holding at the moment is 12.75%, and this is dropping to 9%, and this is just because I'm trying to add more to the portfolio, and I don't want to dilute other holdings that are probably more preferable for me at the moment. Another one I'd want to highlight is DCC PLC. This hasn't been added to the portfolio yet, but looking at all their historical data and the way the company works, it's definitely worth adding to the portfolio. As looking through, its earnings per share is £3.13, which again is a really positive number. However, the yield is only 2.07%. Now for me, I'd want something a bit higher than that, but the historical records, it is always paid out a dividend, it is always paid out a similar dividend, and the dividend has increased consistently for the last 20 plus years. So it's a good solid company to be invested in, and I'm not sure why I've not invested in it before. And the last one I want to mention to you is Aviva. I want to mention this because it doesn't really fit with the criteria that I look for in a company. So it is very much of a risk, and this is why I'm keeping the holding quite small. It's 4.94% at the moment, and that's only ever going to increase to 5% when it rebalances. But this is going to be one of those companies. I'm probably going to reduce it more depending on how well the company does in the future. As we can see, earnings per share is £0.64 or 64 pence, which isn't great, but the yield at 3.26% is good. But obviously, if its earnings per share are, well below £1, how much can it sustain as dividend? And that's the sort of concern I have with it at the moment. But it is a large insurance company in the UK, and they're always going to be around, and I feel like Aviva will recover from this situation, and I feel like holding this longer and the share price should recover to what it was, this time 1 year ago, and hopefully we'll see some gains from it. So now I've had a quick look at the portfolio. I just wanted to say that there are a lot of shares and companies that do fit into the criteria, or at least enough to be considered adding to the portfolio. But I need to bear in mind what sector the company is in, as I don't want to overload the portfolio with one sector or another. Diversification is the best way to have a successful portfolio. The more diversified you are, the better you are going to be at protecting your investments from any changes in any industry or in the economy. One of the big sectors that's changing at the moment is the energy sector. There's a lot of big changes at the moment, people moving away from fossil fuels into renewable energy, and the older oil companies like Royal Dutch Shell, which I do hold, are needing to look at ways to change and move away from oil and move more towards renewables as they're trying to diversify their sort of company's energy portfolio. Another thing to bear in mind with this is, cars are going electric or hybrid, which means there's going to be less demand for petrol and diesel. So it's going to reduce in the coming years, and Shell and BP need to be prepared for that. So currently my portfolio has a weighted dividend yield of 3.03%. So based on the £1,000 that I've invested, it'll grow to just shy of 20 grand in 100 years. So basically, in order for this portfolio to grow, it will need regular investments. But for now, I'm trying to leave it as much as I can just to see how much it can grow off just my £1,000 that I've put into it. However, it's not all as bad as it sounds, as some of the companies in the portfolio are at all-time lows or near all-time lows. And in the case of Lloyds Banking Group, they've been down there since the 2007-8 financial crisis. But I've got great confidence in Lloyds shares will return to their mid-2000 values at about 300 pence or £3 a share, which, based on its current value, is about a 900% growth, because they're at 30-ish pence right now. Likewise, I mentioned Aviva before. If Aviva can get their prices back to the sort of pre-crash prices they were at 851.5 pence or £8.50, shall we say, that would represent nearly 200% growth based on the price now. So my current plan with this is I'll be adding DCC and Coca-Cola into the portfolio in the next round of investment, which I'll be looking at doing probably early August, mid-August. But I'm also looking at adding PepsiCo, 3M and Sage Group. I'm aiming for around about 25 to 30 different companies by the end of buying, and then I'll just leave them all to grow themselves. Now, with recent events happening, there's been a big shake-up in the UK dividend market, and a lot of companies have taken this opportunity now to reduce, cut or suspend their dividends, and this is going to allow them to keep money in the company. I mean, it's a sensible thing to do. Dividend payments have been one of the big driving forces for investors in UK companies. Whereas in markets like America, a lot of the companies focus on reinvesting their excess capital back into the companies to generate growth, rather than paying out the profits to the shareholders. Now, I personally can see this becoming more of a common thing in the UK markets. There are a lot of companies that overstretch themselves to pay the dividends, so reducing that down is going to be more sensible for the company and allow them to probably grow more and reintroduce a better dividend when they're in a more stable condition. So going back to my mention of Royal Dutch Shell, looking at the figures we put up earlier, they only just have enough cover for the dividend. With the changes it's going to be making, I don't think it can maintain the current dividend rates that it's paying. So it has cut it, and I think it's going to stay at the reduced rate for the foreseeable future until it can generate that growth by reinvesting back into itself rather than paying out the dividend that everyone so much wants. So with my mention of Aviva and Lloyds before, I'm hoping I'll be able to take some profits off them as they grow back in price, as the dividends are reinvested, or as I've reinvested in them if they're not paying a dividend, which a lot of them currently aren't. Hopefully, once the shareholding increases, once they get to a reasonable price, I can, take out some profit or all the profit, take my money back out, and then just have just the gains that are left in there. So based on that, assuming that yields stay the same, in the case of Lloyds, it's currently paying a dividend of 1.1 pence per share. And if that's based on the current projections of growth going back up to its, £3 a share, that would be 11 pence a share. So obviously if I'm buying the shares cheap now and then getting a higher dividend then, it will grow the portfolio much quicker and the dividends are going to increase more over time. But this is going to take quite a long time. It's taken Lloyds years to be in a position to start paying a dividend again, and with what's gone on now, it's going to take many, many more years. So whilst we wait, I will be reinvesting into it just to help it pick up a bit of steam, otherwise it's going to be stagnant for however long, and that's not going to be interesting to be watching. So then, hypothetically, this portfolio grows well and you're getting to that point when you're looking to retire. When do we, stop the tap? Stop it dripping? This is when you'll need to determine how much income you're going to need to live off every month and work out if the dividends coming from your investments will either match or exceed your expenses. Currently, the average yield for the FTSE 100 is 4.11%, and the S&P 500 is down at 1.93%. Now, I think some of this is down to the current, situation we're seeing around the world, and I'd hope that some of these averages will recover over time. Interest rates will start to rise again, and this should push the yields up. Now, there's always the worry of inflation, and when it begins to rise again, this could easily raise the income coming from the dividends. Currently in the UK, inflation is at 0.8%, but this is, it's not going to stay there forever. The target inflation set by the Bank of England is 2%. So with all this taken into account, currently your 4.11% return on your FTSE shares will come down to 3.31, taking into account inflation. But if inflation gets up to that 2%, you're losing half straight away. Initially, I was thinking of only publishing updates every month, as whilst it's only starting out, I don't think there's going to be many changes made, but I will keep everyone up to date with how it goes, and any changes I do make, I'll make sure I make a video on and get it posted out to you all, just so you know where I'm at with everything. Looking at the dividend payment dates for some of these companies, a lot of them are looking in and around about the September time. So hopefully, come September, there'll be more interesting things happening on the portfolio, but we'll just have to wait, a month or two until that. Now, I know someone's going to think I've invested in the wrong thing, which is fine. Everyone always makes mistakes, and I think personally with myself, Aviva and Lloyds could be a mistake that I've done. So, please put in the comments below any companies that you think I should have invested in, or ones that I should get rid of now. Please let me know. And if there's enough people who recommend or advise on different shares, I'll set up a completely new pie with £1,000 and invest in the companies you want me to, and I'll compare my portfolio to your portfolio every time, and we'll see who's doing the best. So now we've gone through that, I just want to remind everyone, again, I am not a financial advisor, I'm not an accountant, none of this information I've given is investment advice, this is just my own personal opinion on what I'm doing with my portfolio. So if there's anything you want to consider, please do your own research, and if there's any queries you have, please seek advice of a professional. With that said, I hope you've really enjoyed this video and found the information, useful. And if you did enjoy it, I would really appreciate you just clicking that like button. And if you're not already subscribed, click the subscribe button, click the notification bell, so you'll be notified every time I make a new upload, and you can keep up to date with how this portfolio is going. Once again, thanks for joining me for this video, and until next time, learn, invest, success.